we were very fortunate. I would have blown the chance to buy See's Candy, but Charlie said, "Don't be so cheap," basically, and we still got it at a pretty good price. But we put $25 million into it, and it's given us over $2 billion of pre-tax income, well over $2 billion.
One of the best investment strategies to use if you want to retire early or start building wealth while still very young is dividend investing. This is due to the difficulty in determining when you can truly retire or achieve your wealth target when using index funds and other non-dividend earning investments. If you wish to retire early, income investment is the greatest investing technique to use because it is simpler to determine your progress than it is for someone not using income investing. To feel more realistic, a goal must be well-defined, entail more than simply numbers, and include an emotional component. If you need $4,000 for your monthly expenses, by adding up your monthly dividend income from your portfolio and dividing it by 3 for equities that pay dividends quarterly, you can simply calculate how close you are to your dividend objective of $4,000 per month. If you total everything up and discover that you receive $1,000 in dividends each month, you will be 25% of the way toward your early retirement objective. Young individuals should opt for investments with greater yields because they can find it more addictive to invest for cash flow as opposed to trying to choose stocks with potential rising share prices. Compared to buying a rental property, investing in high-yielding securities needs less research and routine property maintenance, and is far easier to liquidate all of your shares.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends.
And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule 1 for me is I'll never own a stock that doesn't pay a dividend. Ever.
All investors should give income investing some thought because it is a rewarding way to invest. Instead of pursuing the highest yields possible, it's critical to choose companies in these categories that are yielding about average for these kinds of investments. One of the most frequent questions is, are investments with higher yields often riskier? No, just because a stock or ETF is offering a yield that is higher than normal does not make it a riskier investment. That is the constant response to that issue. Now, when it is said higher than normal, it is referring to the market's average yield. As of late December, the average dividend yield for stocks in the S&P 500 was 1.78%, according to the Investopedia. Alternatively, if you look at the average higher yield, an ETF with the ticker code SCHD now gives a yield of 3.71%. We can always find familiar stories like this. The majority of financial advisors advise people to stay away from high-yield investments, but there are a lot of people who favor dividend investing. They research various stocks and ETFs that distribute dividends to shareholders and invest in stocks or ETFs with 10%, 12%, or 14% yields. However, they often realize investing in stocks only by higher yield was a mistake. After holding these investments for some time and witnessing the share prices decline significantly or going through a dividend cut, they then sell their investments at a loss, and occasionally they decide to stop this dividend investing strategy altogether. The phrase, "don't chase yields," is sometimes simply understood as avoiding investing in anything above a predetermined yield by people who are interested in dividend investing. However, everyone interprets that differently. There isn't a magic number you can count on. There is no such thing as I'll be safer and more likely to avoid a dividend cut if I don't invest in anything that has a dividend yield beyond the magic number. No matter how outstanding a stock is in terms of dividend payments or growth, there is no assurance that dividends will never be cut at any time. The dividend aristocrat VF Corporation, VFC, has increased its dividend for 50 years running. Every year since it began, VF Corporation has increased its dividend, even in 2020, a year when the coronavirus pandemic severely impacted the company and the general economy. The business of VF Corp is considered recession-proof, and people believe it can continue operating at a high profit level even when the economy is weak. But VFC management's announcement several months ago that it would right-size the dividend, a drop of nearly 40% to 30 cents each quarter, translating to a dividend yield of 5.24% at now, disappointed lots of people. The other example is the most notable stock in recent months, Intel, which dividend growth investors promoted as a safer investment. Without a dividend decrease, Intel stock has successfully maintained its dividend for 23 years. The corporation then stated in February that it would be cutting its dividend by 65%. Intel stock had been rising for years, winning the hearts of many dividend growth investors, but eventually, like any other firm, regardless of its dividend yield, it was vulnerable to difficult times. It is inaccurate to imply that a lower yielding or average yielding company is always a safer option. The yield that a stock offers is irrelevant. It may eventually have its dividend cut. What some individuals are not aware of is that some stocks have to offer higher dividends by nature.
When you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because, you know, let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either.
For instance, almost all REITs provide yields that are above average. It's because by law they have to distribute 90% of their profits to shareholders. Publicly listed U.S. equity REITs reported a one-year average dividend yield of 3.24% as of December 13, 2022, which is significantly higher than the average, and some can yield even significantly more than that. The fact is that there are some dividend stocks in the S&P 500 that are good, others that are medium, and some that are poor. There are numerous REITs that offer yields that are higher than the industry average and have maintained their dividends for many years. On a lot of websites, you can always find the list of those REITs, which have not reduced their dividends in decades. However, some office REITs have started to cut their dividends as the economy has not recovered as expected. Business development companies are another example. The rules for these investments are comparable to those for REITs, and BDCs must distribute 90% of their profits to shareholders in the form of dividends. BDCs give regular retail investors the chance to make indirect investments in small and medium-sized businesses. Previously, venture capital was only available to accredited investors who wanted to participate in early-stage or emerging businesses. Additionally, BDCs appeal to income investors. BDCs often have high dividend yields of above 6%, and many of them pay dividends monthly rather than on a more conventional quarterly basis. A bear market is currently in full swing. Rates of interest are skyrocketing. While layoffs are occurring, stock prices are still declining. If the higher dividend yields are implying a higher risk, then dividend cut announcements should have been everywhere. However, at the moment, we haven't seen any announcement of a dividend cut from them. On the contrary, due to their investments in floating rate debt, several BDCs have been raising their dividend distributions over the past year as a result of the high interest rates in our current climate. So far, the dividends paid by this high-yield industry have not been decreasing. Like everything else, share prices are declining, yet incomes continue to flow in and increased.
I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market, to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment.
If you choose to invest in stocks with greater average dividend yields range, such as REITs, BDCs, and so on, you'll normally be a lot safer if you invest in stocks that are yielding within that range. For instance, if you buy a stock with a dividend yield of 18% to 20% in the sector of BDC, whose average dividend yield ranges from 6% to 12%, it can be inferred that this dividend is not sustainable and the stock is more likely to see a dividend cut. Although it is not an exact and absolute idea, it can aid investors in identifying some fundamental safety margins. To make it short, when a stock offers an absurd dividend yield beyond the average dividend yield range for that kind of asset, you should be aware that it could be a very dangerous investment and is more likely to see its dividend cut. There is risk associated with both investment and dividends. Even well-known corporations choose to reduce their dividends during tough times, but neither high returns nor low returns are always indicative of risk. The characteristics of the company you are investing in often determine high and low returns. As long as you are aware of the range of dividend returns for the industry the stock is in when you invest in it, and don't aim for absurdly high returns, you can significantly lower your investment risk. We appreciate your watching. Please hit the like button below if this video helped you in any way, and don't forget to subscribe to the channel. Thanks again and see you next time.